And for those of you who are joining us, we're going to get started in just a few moments. We're just going to let everybody get logged in here before we start. Okay, it's right at the hour. We're just going to let people log in here, and we're going to go ahead and get started in just a moment. Okay, let's go ahead and get started. My name is Loreen Gilbert, founder and president of WealthWise Financial. I'm here along with Nicole Anderson, founder of Anderson Law Group, and we are happy to be here to talk to you about new legislation that has passed, both the CARES Act and the Secure Act, and to explain how it impacts you. So I'm going to go ahead and get started and go through some of these provisions. We're going to start with the CARES Act, and then we're going to get into the Secure Act, and then we'll open it up for Q&A after that. So the CARES Act, first of all, has an impact, surprisingly, on the donations, the charitable donations that you made. And a lot of people didn't realize that that was part of the CARES Act. But before this act, there was a limitation on the amount that an individual could deduct to charity. And that deduction was 60% of adjusted gross income. You might remember that it used to be 50% of your AGI, and then it was lifted up to 60% of AGI in the tax reform that went through. And that could be deducted for cash donations if you itemize your taxes. So that was also a change with tax reform. But the new bill, the CARES Act, allows for individuals to deduct up to 100% of their AGI in 2020. Huge relief for charities and an opportunity for individuals. And even those individuals who do not itemize, there's also the ability to donate up to $300 in cash and receive an above-the-line tax deduction. So for those of you who no longer itemize because of tax reform and then thought you couldn't deduct money that you give to charity, there is this $300 rule. For those of you who donate a lot of money and you are itemizing, there is this expanded ability to up to 100% of your adjusted gross income in 2020. In addition, for corporations, the limitation was 10% of your taxable income that could be deducted, and that now has increased to 25% of taxable income. Another great opportunity for corporations, whether you're an S Corp or a C Corp. Let's take a look at this provision to help you get increased deductions for the year 2020. So that has to do with donations. Now let's look at retirement plans and the CARES Act and what some remedies there are for people. So because of COVID, there's a waiver of penalty on early hardship withdrawals, there's increased loan limits, and there's a waiver of required minimum distribution. So let's take a look at what this means. So on the waiver of penalties, there's normally a 10% penalty on early withdrawals from an employer retirement plan or an IRA. So pre 59.5 rules. Those penalties, that 10% penalty in 2020 can be waived. Also waived on withdrawals up to $100,000 maximum. Now, there are qualifications that are required. So either you have to be diagnosed with COVID, or your spouse or dependent was diagnosed with COVID-19, or you're experiencing adverse financial consequences as a result of being quarantined, furloughed, laid off, work hours being reduced, being unable to work due to lack of childcare, all due to the COVID-19. Closing or reducing hours of a business owned or operated by the individual due to COVID-19, or other factors determined by the Treasury Secretary. Now, the bottom line is that individuals may self-certify that they qualify. So there's going to be a lot of latitude here as a result of COVID. As far as flexibility, hardship withdrawals are still subject to income tax. However, the taxes on hardship withdrawals can be paid over a 3-year period instead of having to be paid up all in 1 year. In addition, withdrawals may be paid back over a 3-year period and be treated as basically like rollover contributions are being treated. With loans, there's also a doubling of the current loan limits for workplace retirement plans. So normally, we would have a $50,000 limit on loans in a qualified retirement plan. With the CARES Act, that's increased to the lesser of $100,000 or 100% of qualified vested account balance. So for instance, if you have $200,000 in your qualified retirement plan, a $200,000 that of a vested balance, you could actually withdraw up to, on a plan loan, $100,000 or 100% of your qualified. So another way of looking at it, if you had $100,000, normally you don't be able to get out $50,000 for a loan. You potentially could get $100,000 out as a loan. Now, this is available for loans made during a 180-day period following March 27th. So from March 27th through September 27th. So as you can see, we're in that period of time right now where plan loans could be requested. Now, it also extends the due date of any loan repayments otherwise due in 2020 for a period of 1 year. So for a period of 1 year following the time when you got the loan, you could defer those repayments. Now, qualification is the same as hardship withdrawals that we went over a minute ago. And like I said, they're going to be pretty lenient. Now, when it comes to plan amendments for plan sponsors are not required to adopt the new CARES Act rules on loans and distributions. They can go ahead and make those distributions and then later make that plan amendment. So there's going to be an extension of the period of time to make those plan amendments for, you can see, to January 1st, 2022 or 2024 for governmental plans. So this is something that you can talk to us about, or a third-party administrator or your record keeper about, to understand if you're a plan sponsor and you want to understand how to enact these plan amendments. Now, when it comes to required minimum distributions, RMDs, they're also suspended for all of 2020, including the ones that if you hadn't taken your 2019 distribution, you turn age 70 and a half in 2019, and you had it up until April of 2020, you fall under this rule that it does not need to be taken. So all 2020 distributions are also suspended. In addition, any beneficiary IRAs are also able to not take those distributions in 2020. Huge tax relief for people with either beneficiary IRAs or your regular IRA and you need to take an RMD. Now, if you already took it, as long as you took it in February 1st to May 15th, you can also put that money back in. So the only relief that's not there is if you took your RMD in January. So as long as you didn't take your RMD in January, you took it, let's say February or up to May 15th, you can actually put that money back. Once again, you can call us or ask us more about required minimum distributions, but a great way to defer and not pay taxes on income. When it comes to defined benefit plans, you can wait to make your contributions. So all the contributions that were due in 2020, you can now wait until January 1st, 2021. So let's say you were still funding your 2019 contributions for your defined benefit plan. You now have until January 1st, 2021 to make those retirement plan contributions for 2019. Now, there could be interest due in that. Once again, we can talk to you about the fine print on that, but you can wait to make those contributions. Also, this other plan status for benefit restrictions, that's a very narrow rule, does not apply to many people. So I'm not really going to cover those details, but once again, we can talk to you about your defined benefit plan and how the CARES Act impacts your defined benefit plan. Now, as far as extensions are concerned, extensions have not really been granted. For the calendar year plans are right now on regular filing requirements. In other words, your 5,500 is due July or October. So that right now is as is. Only those plans that had a non-calendar year due in April, May, or June were extended to July 15th. But keep an eye out for this. We actually expect that there might be another extension for filing Form 5500s that are coming. So that is the part of the CARES Act that I have to go over with you. And Nicole, I'm going to turn it over to you. And Annie, let's make sure that Nicole is unmuted so that she can go over the Secure Act. Nicole.
Thank you, Loreen, and thanks so much for having me. I'm Nicole Anderson of Anderson Law Group. I'm an estate planning and business law attorney, and I really appreciate the opportunity to co-present with you, Loreen. Before I go into the Secure Act, I just wanted to make one practical point about the retirement plans and the PPP loan if you have recently received a PPP loan. If you've recently received a PPP loan, even though you're able to defer your retirement plan contribution, you might still want to make the contribution because that could count as part of your payroll. So that's just one thing I was thinking of when Loreen mentioned that. So let's talk about the Secure Act. The Secure Act was signed into law on December 20th of 2019, and it radically changed the estate planning for clients' retirement plans. So except for a few classes of beneficiaries, the life expectancy payout is gone, and it's replaced with a maximum 10-year post-death payout period for most retirement plans. So this is a big change. However, for the good news is for most people, you don't have to do anything about this change. You just have to review who your beneficiaries are of your plan, and you can do that with Loreen, and just make sure that it still fits in with your estate plan. I want to now go over these 5 specified categories of people that are still eligible for the lifetime payout. So this is a really big deal, right? Before, you were allowed to defer the payments on retirement plans over your life expectancy. So for example, if you were a 50-year-old and you received your mother's IRA, you now have to withdraw the entire account over 10 years instead of over 34.2, which was your lifetime expectancy payout period. So you can see what this is doing is it's really making you pay the tax faster. And for beneficiaries, they're going to incur the tax faster. So this is going to infuse a lot of money back into our system. Okay, so let's talk about the 5 categories. We have surviving spouses, so that's good news for many of us. So we also have minor children. There's a caveat to that we'll talk about. Disabled and chronically ill beneficiaries, and beneficiaries that are less than 10 years younger than the participant. So these specified categories are still entitled to receive a modified version of the lifetime payout period. Okay, so let's go to the next slide. So let's talk about the surviving spouse. So for many of us, this is still really good news. The surviving spouse will use the lifetime expectancy payout. However, on his or her death, then that exception stops, and then the successor beneficiaries would have to fall into this 10-year payout. So again, for most people, the good news is that your surviving spouse can still stretch their benefits over their lifetime. Let's talk about another exception, minors. So if you have a minor child, you have a modified life expectancy. Minor children can still stretch it over their lifetime until they reach the age of majority. So that's typically 18 or 21, depending on what state you live. So let's just say 18 here in California. So minors can stretch out that benefit until they're 18. And then once they reach the age of majority, then the 10-year rule starts and applies. So this is a big deal. If you have minor children, you have to really ask yourself, are you comfortable with your children receiving those benefits from the time that they are 18 to 28 years old? As a mother of 3, I don't think I would be comfortable with that. Typically, you would talk to your estate planning attorney and Loreen about how to properly designate the beneficiaries for those minor children. You can still use trusts, but trusts are still subject to that 10-year rule. So a properly drafted trust would still you'd still have to pay the tax within those 10 years, but you could stretch it over their lifetime. Loreen and I are going to go through a couple of other alternatives at the end of this. So then I'll quickly go through the remaining exceptions. We have disabled beneficiaries and the chronically ill. So for those categories, the Secure Act says, yes, they can still stretch over their lifetime, and then on their death, the 10-year payout rule starts and applies. Okay, so let's, oh, one more, sorry. Also, you get to have the life expectancy payout if the beneficiary is more than 10 years younger than the participant. So that's also a positive thing for many of us. Okay, so let's talk about some planning opportunities. So Loreen and I are both going to talk a little bit about Roth conversions. So if the IRA owner is in a lower tax bracket than the expected beneficiaries, or I think if the IRA owner also has a taxable estate on their death, so they're subject to death taxes, a Roth conversion can make a lot of sense. Of course, we would always need to take your circumstance. We'd have to figure out what is best for you, and Loreen could help you run the numbers there, because what happens in a Roth conversion is you convert your traditional to a Roth and you pay the taxes the year of the conversion. Now, if your income is significantly down this year because of COVID-19, that might be another good reason to convert to a Roth. So you've paid your tax, and then when you take out the remaining IRA, it's tax-free. So if you think you're in a lower tax bracket now and you might go to a higher down the road, if you have an estate tax situation, you can pay the tax now, and then your beneficiaries get those benefits tax-free. Also, something that Loreen and I do often together is charitable trust. So in leaving a traditional retirement plan to a charitable remainder trust can essentially eliminate the income tax on the IRA and provide lifetime payout to the human beneficiaries. So this is a huge loophole to this. It's completely legal to do. This is a way that if you have, for example, minor children, you can still leave your beneficiary as your charitable remainder trust, and then those minor children or your beneficiaries will receive lifetime income or income for 20 years with going to charity. Now, some people might not be as charitably inclined and say, I really don't want to leave the remainder to charity. Well, we can even work with Loreen's office to purchase a life insurance policy, and the life insurance policy can pay out to the beneficiaries. The beneficiaries then still receive all that income over their lifetime. You get a deduction on your estate tax return, and your beneficiaries still get the insurance money. So this is a very popular tool, and it's even better now that we have the secure rules. So Loreen, do you want to touch on that at all?
Sure. Oh, on the top two. Well, I was just saying on the rough conversions, we can definitely look at the tax consequences and do a cash flow analysis to see if it does make sense, because our financial planning tool that we use will allow us to do a what if scenario for that very purpose and look to see on a cash flow basis if it makes sense or it doesn't. And then as far as the charitable remainder trust is concerned, definitely, we use this as a tool beforehand for people who were subject to the income, what's it called, Nicole, the income remainder and from an IRA.
Oh, income in respect of a decedent.
Income with respect to a decedent. And so it works very well for that reason, as well as now with the new changes in being able to stretch an IRA. So there are many reasons to be looking at a charitable remainder trust with your IRA money to use it as a beneficiary.
Yes, and again, we can take your individual circumstance, and Loreen has a way that you can show exactly to a client. So you can do a cash flow analysis on that as well. So it's just to explore, especially if you don't like the idea that your beneficiaries would have to take your entire retirement plan out and pay the taxes on that in 10 years. So people don't realize and don't think about their retirement plan about being a part of their estate plan. But for many people, it's a large part. You've worked hard, you've saved this money. You might have some concerns about having your beneficiaries receive it in 10 years. So a couple of positive things that came out of the Secure is there's no more age cap. So you can contribute to an IRA for as long as you want. And you now you don't have to take your required minimum distributions until you're 72. So that was bumped up to 70 and a half. So those are some positive things that happened out of.
A lot of people love that because so many people don't want to take out their RMDs when they turn age 70 and a half. So stretching it to 72 definitely helps. So I'll go over these retirement plan changes with the Secure Act. So one of the great benefits of the Secure Act with retirement plans is that if you are a plan sponsor and you want to start a retirement plan, but you're not sure if you can do it or not, you can actually wait until April 15th of the following year to start the plan for the prior year. So let me use an example. Here we are in 2020. Let's say you're thinking about starting a defined benefit plan, a cash balance plan for your company, but you're not sure with COVID what that cash flow is going to look like. You can actually wait until next year, 2021, up until April 15th to get those documents signed that will go back to 2020 and allow you to fund that whole year of 2020. In addition, for those thinking about starting a retirement plan and you haven't done that yet, there are tax credits for starting a retirement plan. Those tax credits are $250 per non-highly compensated employees, up to a maximum of $5,000 tax credit, and a minimum of $500 of a tax credit. So even if you had two non-highly compensated employees or even one non-highly compensated employees, you can get a $500 tax credit. If you have a lot of employees, you can get a maximum of $5,000 of a tax credit. So that was to encourage plan sponsors to start a retirement plan. And we are starting retirement plans for people, this is a great benefit for people to look at for a tax credit in 2020.
Yeah, and
Another
again,
yeah,
sorry. And again, Loreen, if you have to spend your PPP money, it's another great way, another great consideration.
Great point. Absolutely. So some additional provisions, it allows parents to withdraw up to $10,000 from 529 plans to pay off student loans. Now, this is federally tax-free, but not necessarily state conforming. We see a lot of things that are done at the federal level that the states may or may not conform to. And you can withdraw up to $5,000 per parent from a retirement plan without penalty for the birth or adoption of a child. So both of those provisions are federal provisions that allow you access to a 529 plan for student loans or from a retirement plan for a child, for a birth or adoption of a child. So those are some key provisions that we wanted to go over with the CARES Act and the Secure Act, and we got through that in less than a half an hour. So we want to make sure that we open it up for questions. And in order to do so, Annie, I'm going to ask you to unmute people that might have a question, and we can address those questions for people who want to ask them. So Annie, I'll turn it over to you.
Sure. Would you like me to just unmute everybody and then allow people to go one by one?
I think that's the best way for us to do this.
Okay, so I'll unmute everybody. Okay, everyone is unmuted now.
Oh, so too loud. Let's mute everybody.
You're welcome. Take care.
Let's mute everybody. Okay, there we go. So unmuting people was too loud. Can they unmute themselves to ask a question?
Yeah, those who are on the WebEx tool online or through their phone can unmute themselves.
Okay. So we'd
People
ask
that are joining
everybody
us
to
via
stay
phone
muted.
cannot.
Okay, we'd ask everybody to stay muted until, or if you have a question. And if you have a question, you unmute yourself and go ahead and ask us that question. So are there any questions? So while we're waiting for some questions, why don't I ask you, Nicole, what questions have you been getting from clients regarding either the Secure Act or the CARES Act?
Well, a lot of clients have had questions on both, right? I think addressing the charitable contribution limits has been one of the hottest topics that I've received lately, right? It's a really a wonderful thing that you have this way to really make an impact right now. And Loreen, you and I have also done a lot of charitable lead trusts together, and with the interest rates so low and these deductions so high, this is a really good time to take advantage of these, loopholes in the rules and do some serious income tax planning.
And I think to your point, Nicole, I think it's whenever we have changes in the law, it's time to review your plan and to look at what are the implications for your income tax planning, what are the implications for your state tax planning, and can it impact on your cash flow planning? So all of those things are things that both your office can do on the estate planning, and then along with our office on the cash flow planning, we can help people with. And for those people who own a business, there are opportunities to look and see how can these rules help them as individuals and as an employer. Let's make sure that everybody has your information, Nicole. Nicole's office and our office, we work very closely together. And Nicole, why don't you give them your information, and we'll make our information available as well. So Nicole.
Sure. Our office is Anderson Law Group, and our website is andersonlawgroupinc.com. And we're always happy to offer Loreen's clients a complimentary consultation we're doing on the phone or by Zoom right now. We're always here to be a resource for your clients, Loreen. We love working with you in your office, and thank you for the opportunity to co-present with you today.
Absolutely. And to reach our office is wealthwisefinancial.com, and our phone number is 949-748-1177. And feel free to email us with your additional questions. We are doing these webinars, pretty much we've been doing them on a weekly basis. We're going to take a break next week because of Memorial Day being on Monday, but the week after that, that following Monday, which would be June 1st, we're going to have another portfolio strategist on the line talking about a portfolio that we use that is positive year to date. So if you're wondering how to have positive returns, even in the midst of the volatility that we've been seeing, then you will want to participate in this. We are very excited to have them on board with us, talking about this strategy and how we're using it for our clients. So please tune in. That will be at 4 o'clock Pacific time on June 1st. And until then, if we don't have any other questions, we just ask you to contact our office, contact Nicole's office with any other questions that you might have. And we greatly appreciate you participating with us on these calls. We can also provide this presentation for you. We'll actually post it on our website with all our other presentations once it goes through our compliance department, and we're posting them on our website as well. So if you didn't catch all of it and you came in the middle of the presentation, then you can listen to the replay because we're recording it. So with that, once again, Nicole Anderson, and Nicole's office and my office, we are separate offices. She's not affiliated with our office. We're not affiliated with hers. She's not affiliated with LPL Financial, but we, like I said, we do work very closely together for our clients. So thank you, Nicole, for participating. Thank you to all the clients on the line, and we look forward to seeing you again, hopefully on June 1st, 4 o'clock Pacific time. Thank you so much.